Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a look at a different problem from the world of investment and consider if the lessons as laid down by the man considered to be the father of the craft, Benjamin Graham, can shed light on the matter at hand. In this episode, we should be taking a look at stocks trading on the AIM market of the London Stock Exchange. This is the sub-market that lists businesses that have much smaller market capitalizations, or in other words, stock market valuations, than those businesses found on the main indexes. We will also be considering investment in smaller companies more generally in a bid to work out both the potential pros and cons of this endeavour. So let's dive right on in. As always, kick back and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. There is something strangely reassuring about investing in large corporations. One of the reasons that this might be so is because the chances are the bigger a company is, the more likely we all are of being familiar of who they are and what they do. And there's no doubt about it, that familiarity can bring about a warm fuzzy feeling which can psychologically make it easier to invest in a business, as opposed to one that is completely alien to the investor. There's perhaps another psychological reason why investing in large listed corporations can feel less intimidating than taking the plunge with some tiny business entity. And that is the well-known principle of obtaining safety in numbers. Investors in general always like to follow the herd, so it can feel a lot more palatable to invest in a huge business where friends and family might have also placed their wealth. If things go well, then they won't miss out, and if things do go wrong, then being collectively wrong at least allows the investor to feel a little bit less foolish. But I sometimes think that because of this desire to stick to what we know as investors, extremely exciting smaller businesses can often be overlooked. I'm talking specifically about the AIM market here today because it is the small caps market that I know the best. But of course there are equivalents all over the world. The AIM market, or the Alternative Investment Market to give it its full title, is currently made up of around 600 smaller businesses. These range in market capitalisation from around £5 billion, which is around $7 billion to much less than £1 million. With the average market cap in this index being around £110 million, which equates to around $150 million. As with everything in life and investment, investing in smaller businesses has its pros and cons. So let's start off with what could potentially work out well for the investor here. When it comes to scope for future expansion and growth, there's no doubt about it, the fact of being small to start off with leaves it with much greater opportunities for exponential growth than is available to a business that is already huge to start off with. A business that already has a dominant market share is not going to be able to double its sales next year and again the year after. The fact is, the bigger a business becomes, the more restricted its opportunities for revenue growth will become. The small business is not bound by these chains. There is every opportunity, if the product or service is good enough, that very high levels of growth can be maintained in perpetuity, or at least for a considerably long time, before they inevitably reach a market share where growth becomes more difficult. It is clear that the investor who has backed the right business and has got in there whilst the business is still very small and has managed to stay the course could do extremely well here. But investing in smaller listed businesses is not all good news. One obvious issue here is the selection of the right stock in the first place. Large businesses have a strong tendency to be well established. This means the investor has available to them vast amounts of historic data upon which they can pour. The very fact that we're able to establish what the business has earned this year and in previous ones, as well as all the other important stuff, enables the value investor to arrive at a confident conclusion as to what price should be paid for a stock. This luxury of the provision of quality data can oftentimes be lacking when it comes to smaller businesses. Many smaller businesses may not have been trading for all that long, or at least been listed for that long, so we may not have the required historic data upon which to form our decisions. Younger businesses also have a tendency to be unprofitable. This can be a normal state of affairs as we look towards future expansion, but this again makes accurate decisions on what price to pay for a stock difficult if not impossible. If we are to say that perhaps the single most important aspect of value investment when it comes to the accounts is the dependability and predictability of earnings, then we have an obvious problem here. The issues for the investor in choosing to invest in smaller businesses does not stop there. Another serious consideration is in regard to the liquidity of holdings in a smaller business. If you were to own a Coca-Cola or an IBM stock, then unless you're Warren Buffett trying to offload billions at a time, then there will always be a ready market and someone willing to take that stock off your hands at the prevailing stock price. The stocks of large listed businesses are liquid because you can sell out your position at any time without the sale of your shares affecting the stock price. This is oftentimes not the case with small cap shares. If a business is only worth $1 million, say, then even a relatively small investment can add up to a large holding in percentage terms. So even if you wanted to cash out a $10,000 holding, there's unlikely to be someone queuing up and ready to take these shares off your hands. This means that you're likely to have to take quite a significant haircut via an intermediary in order to get rid of a big block of shares fast. Selling out of small cap businesses can therefore be quite time consuming and patience trying if you want to do so without your actions adversely affecting the stock price, and will require lots of small sales at opportune moments. And this brings us nicely to the next issue likely to affect the investor in small cap businesses. Because even a small sell-off of shares will likely have an outsized effect on the stock price, this inevitably makes stock prices highly volatile. So some fellow investor sells off a few $1,000s of stock in a business for no other reason than to pay for the deposit on a house, say, or a wedding, or to settle a tax bill. And suddenly you find the price of your holding instantly dropping by 10%. And it's obvious why this can be disconcerting and off-putting for the would-be investor in a small cap business. So where does this leave small caps as a destination for equity investment? The first thing to say from the viewpoint of the value investor is that seeking out great opportunities is not exactly as easy as shooting fish in a barrel. Issue number one is always likely to be the deficit of useful historic accounts. History here will often be short and therefore unlikely to be sufficient to base a sound conclusion upon. Even where sufficient historic data does exist, often this will not be useful to us, as it is unlikely to highlight solid trends of performance that is more commonplace in the historic accounts of large and well-established businesses. However, the fact that something is hard to come by does not mean something is impossible to obtain. On more rare occasions, businesses can be identified that do have accounts that are both useful and meaningful, and which can be used as a basis to arrive at a sound quantitative conclusion, in which instance the business may be assessed for attractiveness or otherwise on qualitative grounds. The other issues we've discussed may be annoying but not unmanageable for the value investor. The issue of poor liquidity will be an annoyance should they wish to sell anytime soon, but if they've got things exactly right with the conclusion here, it need not be an issue. In purchasing a small cap company, the value investor is presumably optimistic about its long-term prospects. And as the value investor likes to hold on for the long term, then this liquidity situation should improve by the time they come to sell. As a business's market capitalization increases, the pool of available buyers and sellers will do too, making it increasingly easier for the investor to sell out of their positions. The final issue, that is of the volatility of stock prices, should be of little concern to the value investor. The value investor should be well aware and expecting larger than usual price rises and falls, based upon events likely to be unlinked to the underlying attractiveness of the business. The fact that someone may have sold a stake that has adversely and temporarily affected the share price may well be more linked to their desire to purchase a car or whatever than their predictions of doom and gloom for the business more generally. And this should easily be brushed off as a distraction by the value investor. So we can say all in all and in conclusion that the AIM market, as well as other markets worldwide listing smaller businesses with smaller market capitalizations, offer an interesting alternative to the more long-established and larger listed entities. While some of the issues that may be more of a problem for those wishing to trade in the markets are less relevant to the value investor, one huge hurdle remains. That is finding something that can be purchased on value grounds. This will not be easy due to the lack of meaningful and long-standing quantitative data that seems to come as part and parcel with smaller, less time-tried businesses. But if a business can be found that does meet the strict requirements, as well as the usual need for a favourable qualitative outlook, then clearly the business will have much more scope for exponential growth than a large company already operating with a large market share. And this, of course, acts as an additional favourable qualitative trait. On that, I shall draw this episode to a close. I do hope you've enjoyed considering some of the pros and cons of investing in small cap businesses. And if you have, please, as ever, consider adding to playlist. That way, you'll be alerted whenever a new edition lands on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.